Good afternoon, everyone. Welcome to the Monetary Policy Committee meeting. Welcome to the Monetary Policy Committee meeting and the decisions that we will be tabling before you and our thinking. We first looked at the current global environment, and in essence, I'm sure you've all been watching very closely, the international discourse and news is currently dominated by global economic and financial market developments. These continue to weigh on domestic economic growth prospects. The immediate concerns relating to the sovereign debt crisis seem to have abated somewhat, although significant risks still remain. Growth in a number of advanced economies appears to be losing some momentum following promising outcomes in the first quarter of the year. We looked at the domestic developments regarding inflation, and the outlook remains favorable, with inflation expected to stay within the inflation target range for some time, against a backdrop of a benign global inflation environment. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas declined to 4.6% in May 2010 from 4.8% in the previous month. The main contributors to the inflation outcome were the categories of housing and utilities, particularly electricity, and miscellaneous goods and services, mainly driven by insurance costs. There are a number of low inflationary pressures. Categories exhibiting very low inflationary pressures included food and non-alcoholic beverages, communication, recreation, and culture. Indicators of core inflation show that inflation is generally subdued, with CPI excluding food, petrol, and energy declining to 4.3% in May, compared with 4.7% in the previous month. Inflation, excluding all administered prices, stands at 3.4%. We've seen that the PPI price measures 6.8% in May 2010, compared with 5.5% in April, driven mainly by commodity and electricity price developments. Food price inflation remained low, with agricultural prices increasing by 0.3% year-on-year basis, while manufactured food prices declined by 1.3% over the same period. This suggests that food prices at the consumer level are likely to remain contained for some time. The CPI forecast of the bank indicates a relatively unchanged forecast compared to that presented at the previous meeting of the MPC. CPI inflation is expected to average 4.5% in the third quarter of 2010 and increase moderately thereafter. Inflation is expected to remain within the target range during the forecast period, and to measure 5.3% in the final quarter of that forecast period, which is till the end of 2012. If we looked at the Bureau for Economic Research inflation expectations, what we've seen is that despite the persistent moderation of inflation within the target range, inflation expectations have remained relatively elevated, albeit with a slight downward trend. According to the survey of inflation expectations conducted by the BER at Stellenbosch University during the second quarter of 2010, average inflation expectations for both 2010 and 2011 have declined by 0.2 percentage points to 6.3% and 6.5% respectively, but have remain unchanged at 6.8% for 2012. In terms of this BER's inflation survey, financial analysts are the only category of survey respondents that expect the inflation target to be achieved during the forecast period. Expectations derived from the markets are similar to those of the financial analysts. The break-even inflation rates, as measured by the yield differential between the conventional government bond and inflation-linked bonds, have declined since the previous meeting of the MPC. These rates reflect an expectation of the continued attainment of the inflation target over the medium term, although close to the upper end of the range. We then looked at the global economic outlook, and we see that global economic growth remains uncertain. In its July update of the World Economic Outlook, the IMF raised the forecast for global growth from 4.2% to 4.6%, mainly on the basis of the higher-than-expected performance in the first quarter of the year. However, some moderation is expected in the second half of this year, with a high degree of downside risk. The sovereign debt crisis in Europe appears to have had a short-term respite, but significant longer-term risks and uncertainties persist. The planned fiscal consolidation and austerity programs in a number of countries are expected to lead to persistently low growth for some time. The economic growth prospects in the United States appear weaker than anticipated, with particular concerns about the continued weakness in the housing market and an outlook described by Fed Chairman Ben Bernanke as unusually uncertain. At the same time, the Chinese authorities have taken steps to moderate the pace of economic growth in China, and the expectation is that we are likely to see an extended period of longer potential growth, of below potential growth in a number of regions for longer. Under these circumstances, global inflationary pressures are expected to remain subdued and are not seen to pose a real risk to the domestic inflation environment. The weaker demand conditions are also likely to constrain global commodity price developments, including those of international oil prices. The price of Brent crude oil has been relatively stable for some time and has averaged around $74 a barrel since the previous meeting of the MPC. We also looked at the question of the exchange rate. The continued low interest rate environment prevailing in the US and the Eurozone has resulted in a consistent search for yield, with a number of emerging markets being the recipients of a significant capital inflows. South Africa has been no exception. Since the beginning of the year, non-residents have been net purchasers of bonds and equities to the value of around 72 billion rand, of which about 51 billion rand were in bond purchases. The rand exchange rate was relatively volatile in the period since the previous meeting of the MPC, with the rand-dollar exchange rate fluctuating between around 8 Rand 10 and 7 Rand 43 to the US dollar. However, since the beginning of June, the rand has been relatively stable and averaged around 7 Rand 60 to the dollar. Much of the underlying volatility can be ascribed to changes in global risk aversion related to events in Europe in particular, which saw a high degree of volatility in the US dollar-euro exchange rate. As a consequence, the rand has fluctuated against other currencies as well. Since the beginning of the year, the rand has appreciated against the euro and pound sterling by 9.1% and 2.9% respectively, while it has depreciated by 2.9% against the dollar over the same period. On a trade-weighted basis, the rand has appreciated by about 1.6% since the beginning of this year. The bank is very aware of the impact of both the level and volatility of the rand on the economy, particularly the manufacturing, export, and import competing sectors. We are ready to continue to play our part in a considered manner, and discussions with the National Treasury about the various options available to address these issues and the availability of resources to do so are ongoing. While a range of levels have been proposed by various interest group or analysts as a desired or equilibrium levels, from 10 Rand 50 to the dollar to 8 Rand 50 to the dollar, we reiterate that we do not have a target level for the rand. It is very difficult to define with precision the degree of over or undervaluation of an exchange rate. The approach when assessing this should be guided by a sense of when the value is clearly not consistent with equilibrium, which itself changes from time to time. Moreover, it is important not to underestimate how difficult it is to achieve a particular range of a weaker currency, or how costly this can be. Any actions would have to be consistent with the inflation target, as there is no point in having a weaker currency if the benefits are simply eroded by inflation. On the domestic economic outlook, we have seen that the recovery has continued. Gross domestic product grew at an annualized rate of 4.6% in the first quarter of 2010, driven mainly by the recovery in the manufacturing and mining sectors. However, indications are that second quarter growth was likely to have been less favorable, and the negative output gap is expected to persist for some time. The bank forecasts economic growth to average around 2.9% during 2010, with the uncertainties emanating from the global economy posing the main downside risk. The relatively unfavorable outlook can be ascribed in part to an expected slowdown in the manufacturing sector. Growth in the sector in the 3 months to May 2010 compared with the previous 3 months measured 1.2%. The Kagiso BER Purchasing Managers Index has been moderating consistently since its peak in February 2010, and in July the index reflected an expectation of a contraction in the manufacturing sector. The construction sector also remains under pressure, as evidenced by the 30% year-on-year decline in all building plans passed in May 2010. Civil construction is also showing declining activity. In terms of domestic household consumption, the RMB BER Business Confidence Index also declined during the second quarter of 2010. Private sector gross fixed capital formation continued to decline in the first quarter of 2010, albeit at a slower rate of contraction. But there are signs of recovery in domestic household consumption expenditure. In the first quarter of 2010, consumption expenditure grew at a higher than expected annualized rate of 5.7%. The recovery was fairly broad-based, except for expenditure on services, which remained relatively subdued. The positive trend in household consumption expenditure is expected to have been maintained in the second quarter. Retail trade sales increased at a year-on-year rate of 4.6% in May. However, when comparing the 3 months to May with the preceding 3 months, an increase of 0.3% was recorded. New vehicle sales increased by 20.7% on a year-on-year basis in June, although they declined by 9.7% relative to the previous month. The BER retail survey suggests that the outlook for the sector remains fragile. After 2 consecutive positive quarters, retail business confidence declined in the second quarter of 2010, and overall business conditions, sales volumes and profitability performed worse than expected. The outlook for household consumption expenditure is being affected by a number of contradictory forces. Positive factors for household consumption expenditure include lower interest rates, lower inflation, positive wealth effects arising from favorable house prices and equity market developments, and high levels of real wage increases for those who are in employment. In terms of the wages and unit labor costs in the first quarter of 2010, unit labor costs increased by 9.6% compared with the same quarter a year ago. According to Andrew Levy publications, the average wage settlement rate amounted to 8.2% in the first half of 2010, compared with 9.3% for 2009 as a whole. Wage expectations also remain elevated, according to the BER Inflation Expectations Survey. Some of the factors that are constraining household consumption expenditure include the continued job losses, the high levels of household debt, and low levels of credit extension to the private sector. According to the Quarterly Employment Statistics Survey of Stats South Africa, employment levels declined further in the first quarter of 2010 as private sector employment contracted for the 7th consecutive quarter. Youth unemployment is particularly evident. If we look at the bank credit extension, we've seen that growth to the private sector turned positive in May, when growth over 12 months in total loans and advances measured 1.4%, mainly as a result of an increase in credit extension to the corporate sector. 12-month growth in mortgage advances has remained stable at levels around 3% since November 2009. There are some indications that in the second quarter of 2010, retail banks loosened their credit criteria somewhat. However, bank lending to consumers may be constrained by the persistently relatively high levels of impaired advances, particularly in relation to retail loans. Demand for loans may have also been negatively affected by the continued high levels of household debt, which measured 78.4% of disposable income in the first quarter of 2010. In terms of the monetary policy stance, the main upside risk to the inflation outlook continued to emanate from cost-push pressures, particularly recent wage settlements and high levels of administered price increases. The Committee is very aware of the fragilities and vulnerabilities of the domestic economy, driven in part by global uncertainties. The Monetary Policy Committee assesses the risks to the inflation outlook as being evenly balanced and views the current monetary policy stance as appropriate. Therefore, the MPC decided to keep the repo rate unchanged at 6.5% per annum. The Committee will continue to assess economic and financial developments, and should circumstance warrant it, the appropriate response will be taken consistent with the Bank's inflation targeting mandate. Thank you. We are open to any questions, and if I can just again ask you to identify yourselves and we'll try to do our best as a team to answer everything that you have on your minds. Miriam.
Mary Lisa from Business Day. Was this a hard decision or an easy decision to reach? Markets were very divided on whether there was likely to be a rate cut or not. And I wondered whether you would be
Thanks. Was it an easy decision or a tough decision? That has a number of elements to it. The conditions are extremely difficult. They're very tough out there, whether it's global or domestic. So any consideration by a responsible group of people makes it a tough decision because you have to weigh the options. If your question's asking was there a difference of view in the decision, the answer is no. I think that the issues, there's a lot of debate. As I indicated last time, we start our meeting on Tuesday afternoon to allow more time for discussion, and that we do have very extensive discussions around the pros and the cons and the implications of what the numbers mean, what the conditions mean, what the situations are. So from that point of view, it is a very difficult meeting because you have huge responsibilities and it's open to how you analyze, how you see, how you interpret the data that is before you. From the point of view of the assessment and understanding, I would say there was no difference of view among the meeting at all. In terms of your question about guidance, I do think we give guidance. We're giving you the sense of where we see the risks, the question that we are ready to act, and that balance, I think, comes forward. What we would not do is set out a path, because, first of all, I think there are very few countries who do that. There are a number of them who do. But the conditions are such that I think anyone who's willing to predict a year ahead as to what their path would be is very, very, must have a great deal of foresight and a crystal ball that we certainly don't think we have. So I do think we give you if you look at the statement carefully, I think we are giving you an indication of where we see the risks lie and what our approach is likely to be. But we cannot say to you, look, this is what we're saying now for 2 months hence or for 4 months hence. I don't think that would be appropriate. Yes.
Hi, Franz Wild from Bloomberg. Governor, do you think that the interest rate cuts that we've had so far are enough to support consumer spending and the economy as a whole? And do you think that going forward, consumer spending will strengthen the current?
If we thought differently, we would have taken a different view. But again, you're looking at the economy as a whole, and we have said that there is a fragile recovery. What is happening with household consumption expenditure, you're seeing some movement in that regard. But in the overall, the question for us would be, it would also depend on what's happening elsewhere. You know, if you look at the growth trend for the country, you're not just looking at consumption-led growth. It's very much a question of looking at what is happening with manufacturing, what is happening in industry, and that will also depend a lot on what happens elsewhere. 1/3 of our manufactured goods goes into Europe. So it does depend on what's the situation in Europe, what is going to happen to manufacturing. So that when we're looking at it, we're looking at the whole. We're not just looking at a decision in relation to consumption. But there's a number of factors that will affect it, and this has been our assessment of the decisions we need to take. I think that what we are saying is that at this point in time, we have kept rates stable. We think that is the appropriate decision. We have looked at what the upside and the downside risks are, and we've indicated where the risks lie. As we said, if you excluded administered prices, inflation would be 3.4%. The question of double-digit wage settlements without the concomitant productivity increases would pose a risk. What's happening in the global environment poses a risk. So in our view, the risks are evenly balanced, and it depends on the outcome what our decisions would be. At this point, we have felt it appropriate to keep the rate unchanged. But as we said, if the situation changes, we would certainly we would continue. And don't forget, we don't discuss this only at a Monetary Policy Committee meeting. The issues are discussed every single day in the bank, in different forums, in different engagements. But certainly we assess what is happening globally and domestically on an ongoing basis. And we've said very clearly in the statement, in the conclusion, that should developments warrant it and circumstances change, and it's needed, we will make the appropriate responses at that time. If you're asking for a long-term horizon view, I think that the data and the information and what is happening is much more volatile globally for us to be able to say to you, we think this is a situation that would pertain into the future indefinitely. We evaluate the data and will respond accordingly. Yes, sir.
Tshepo Mongwai from SABC Radio News. I've got two questions. Firstly is, now that the Reserve Bank has this broad mandate, do you ever consider the views of the labours in terms of what they say? And second question is on the rand. Governor, when you took over as the governor of the Reserve Bank, you welcomed discussions around the issue of the rand. Would you say that those discussions so far have sort of taken direction?
In terms of the broad mandate is not simply a question of taking account of labour. It's taking account of everything in the country. And as you are probably aware, we have a program which is the responsibility of Dr. Mnyande here, in which we engage with all segments of society. So we are certainly meeting labor unions, the different federations. We meet the political parties. We're meeting different organized business. We're meeting difference in sectors, because the objective for us is to get a deeper understanding and see how people see the issues from where they sit, so that when we gather this data together, we have had a process, a very intensive process, of looking at what is happening both from an all-round perspective. So teams of people from the research department will visit factories, will meet with others, and certainly we have organized meetings in which the leadership of the bank and the leadership of those different sectors meet. So certainly we listen to and very closely pay attention to what is actually happening in the real economy. So from that point of view, I think that we welcome the engagement and have certainly looked at an interaction with the different sectors, whether it's labor union or different sectors in the economy, and the academics and the analysts, to look at it and say, what do you see? How do you see it? Why do you see it? And have a discussion around it. So all of this is working to inform the decision we take. On the second question about discussions on the rand, I'm sure you saw President Zuma's statement this morning that Cabinet is certainly exercising its mind on the rand. We've spent quite a bit of time discussing it in our statement today. It is certainly something that we discuss. And in all these discussions that we have in this outreach program, the agenda is open, and those people who would like to put the rand and the exchange rate on the table certainly do. So it is a process that is underway and in discussion. Yes.
Thank you, Governor. It's Francis from E-News. You said that you would consider and you would play your part when it comes to the volatile rand. Can you be a bit more specific? Because the OECD was suggesting you up your reserves, bring down tariffs. Can you be more specific on what you are looking at doing?
Well, the question for us is, what is the role of the Reserve Bank in that? And we've been very clear that rebuilding the reserves is something that we are committed to. So the question for us would be, can we expand that? What are the resources? And that's why I refer to ongoing discussions with the National Treasury. This is something that, you know, we see very much as part and parcel of our understanding of the need to have stronger reserves and more reserves, especially in a more difficult climate. So that work is ongoing. If you looked at it in relation to other measures proposed by the OECD, a lot of them do not necessarily relate to the Reserve Bank. I mean, we don't set the tariffs and we don't do take those kinds of measures. So when you're looking at the currency, or when you're looking at building reserves and you're looking at the exchange rate, it must be a combination of what all the players do. The bank has a particular role within that, and that, in our view, we are playing to the best of our ability. I first want to see Mary with the other hands. Hilary?
You must be getting a bit tired of the OECD, Governor, but could I pick up on two more of their recommendations? The one, it's not clear what they're recommending, but they make the point that one of the reasons that inflation targeting is not working as well as it should be is that businesses and unions still look backwards at inflation, not forwards at inflation, and that is so that your policies doesn't have the credibility it should have. Do you agree with that assessment, and what do you think you or anyone could do about it? That's the first question. But the second question is perhaps not a MPC question specifically, but both the OECD and some of the members of the Harvard panel have made the point that if we could run tighter fiscal policy in South Africa, that could create the space for looser monetary policy. And I was wondering what you thought of that assessment.
Thanks, Hilary. On the first one, and I'll ask my colleagues to add as well, I think the question of inflation targeting not working as well as it should, I'm not sure that's accurate, in a sense that we are within our inflation targeting band, and the minimum it's done is everybody talks and looks at what the implications for inflation on what we do. So again, inflation targeting is a tool. That's what it is. It's simply a guide, a tool that you can utilize to influence people. And I think it is fairly natural that labor and business tend to look at what was their experience as to what they experienced last year in relation to what they would anticipate. So there's a lag effect. And I think that that is normal. You can't ask business to say, okay, or labor to say, inflation is here, we think it's going to be there, so our demands are actually going to be where we think it could be. The objective is to try to influence you down into a thinking that, and a confidence that, that the inflation will be lower and within the bands that you can then demand your wages accordingly. And in that sense, I do think that there's a lot of work still to do, and part of it is a consistency of having inflation within the levels that people can see it is really there for a sustainable period, because that's how you influence the expectations. In reality here at the moment, though, is that a concern is that a lot of the demands for wages are virtually double inflation as it stands, and that is not something consistent even with, if you looked backwards a little bit. So there's a huge challenge around influencing those expectations. And I think a greater knowledge and understanding of how much inflation erodes the value of your money is something that should be equally important to labor as it is to business, as it is to those of us who are trying to maintain a low inflation environment. It gives you much more room to move if you've got a low inflation environment. In relation to the question of tighter fiscal policy, I think you need to speak to the Treasury about that. Miriam? Sorry, let me just ask if there's anything you wanted to add in relation to the OECD. Brian?
I think on the issue of, I'm not going to comment as to whether the Treasury should be having a tighter or looser fiscal policy. But I think what we have seen, where those analyses are correct, is that the more tight fiscal policy is, the looser monetary policy can be from an inflation point of view, because some of the stimulus to demand that would come from lower interest rates would be offset by the tighter fiscal policy. Where we probably don't agree entirely with the analysis is with respect to the impact on the exchange rate, because part of the objective of this is to have a lower interest rate in order to weaken the exchange rate at the same time. The tighter fiscal policy would then help to offset the inflationary impacts. What we have seen in South Africa is that capital flows don't always respond in a predictable way to lower interest rates, that having low interest rates to the extent that they are growth positive may result in the opposite to what is intended, and you may land up with higher inflows into the equity markets, and in fact more sustainable inflows than in the alternative scenario.
Miriam?
Thank you. I'm afraid I have yet another question on the rand. You gave us quite a lot of detail of your thoughts on defining over or undervaluation, but I was wondering if you would be willing to say whether now the rand is overvalued or undervalued in relation to its equilibrium now as you see it My second question is very quick. I see you've revised your growth forecast for this year up to 2.9%. Have you revised the one for next year up as well?
I'm going to ask my colleagues to participate. XP, would you like to take the first question and second question?
I think by definition, if you're running a current account deficit, amongst other things, that would be an indication of some degree of misalignment. As to the extent of that misalignment, I wouldn't wish to deviate from the cautions that are contained in the statement. It is difficult. It depends on a variety of factors, all of which can change at changing rates. So yes, there is a degree of misalignment, but I wouldn't wish to go beyond that.
The growth forecast increased marginally from 2.7 to 2.9, mainly on the basis of the higher than expected first quarter outcomes. So it's not an upward revision of the rest of the year. It's almost, in a sense, an upward. It's building in what is already happened. So it's to an extent, it's not a statement about what's happening for the rest of the year. But the forecast for next year is more or less unchanged.
Kosim? Has someone got a mic on? Yeah, Hillary, you need to switch your mic off. Thanks. Try it again.
Kosi from Summit again. I just wanted to find out about the rand again. In your personal view, do you favor trying to weaken the rand? And to what extent is the Reserve Bank actually capable of doing so? And then another question is concerning the wage deals that you did mention, the double digit. And I just wanted to find out, are you conveying your concerns to the unions and government? And does the Reserve Bank have any influence in this regard?
As I said, my colleagues are going to participate at this point in time. In terms of the rand, who would like to take it this time? XP?
It's very difficult to go beyond what we have said. Can we influence it? Yes. Can other people influence it? Yes. Can they influence it in a manner that they can control? Arguably. So I don't think we would want to enter that particular territory, other than to say it is an important price for the economy as a whole. Prolonged misalignment will have deleterious effects, but the system does tend to equilibrate itself, and what one must do is to assist that process of adjustment in an orderly and reasoned manner.
And the question of wages?
Well, I don't think it's a question of wages alone. I think that you have to look at the entire range of the cost structure of the economy. So you can't pick on one sector and not look at the others who are involved. Certainly, as the governor has said on numerous occasions, nobody says that wages should not increase, but the increases have to be purchased by a compensating increase in productivity. And that is the basic principle all the way around.
Governor, you were quoted as saying that the outlook on interest rates it's more steady. So I just want to find out if you maintain that view.
Tsepo, I've spent the last few minutes explaining exactly how we see that. So the question is, as we see it at the moment, we would be looking to say that at this point, with the information before us, we have kept rates on hold because we think that's the appropriate decision. It certainly is not something that we're able to say in 18 months we'll still be in the same situation. The world situation is very fluid. It is very difficult. And depending on what occurs, we will then act accordingly. At this point in time, we think the holding the rates where they are is the appropriate decision. Hilary? Tsepo, you just need to switch your mic off, otherwise Hilary's gagged. No, you're fine now. You switched it off, so you're on.
What is the Reserve Bank's estimate of the potential growth rate? In other words, how big is the output gap at the moment as you see it? And another question, you've pointed out that the inflation rate, excluding all administered prices, is now near the bottom of the target, in fact. Is there scope, do you think, to, well, would bringing down some of those administered price increases help you? And where do you think there is scope for curbing them?
On both your questions, I think that, if I'm correct, the output gap is about 3 3/4 to 4% potential output gap. So that's what 3 3/4 to 4%, the potential output gap. In terms of that, it's a point we're making in relation to say if administered prices were excluded, the inflation rate is at 3.4%. But the point is they're not excluded; they're real. They affect your inflation and so on. But what we're pointing out is those are things you have some measure of control over. It's not just something that you don't control. And therefore, is there room? That's why we feel it should be looked at. Because it is those are areas that there is an influence by bodies around what you are allowing through. And to look at whether the administered price route is the most appropriate way to meet some of the finances needed for those areas. It's not that we're not querying that the finances are not needed. We're just saying there's an inflationary impact on what is happening and drawing attention to that. But we're excluding it from the point of information. You can't exclude it from the real economy. It impacts. Any other questions? But not the same question in a different way, huh? A different question.
I just want to get your personal view on the weakening of the rand.
But we've just dealt with that.
I'd like yours, Governor.
No. This is a question. I'm not going to say anything different. We've said it. And it isn't appropriate at all to say, I want your view, Governor, compared to the MPC. We're all responsible. And what Dr. Guma has said is my view as well. So you're not going to sit here and have different views. We've discussed it and we have a view, and it is the view of the MPC. And in that sense, there isn't a personal view as distinct from a view of a governor. Okay. Anyone else? You're all fine. Thank you very much. Thank you very much for being with us today and for your questions and contributions, and you're always welcome. Thanks very much to the MPC members. Oh, and just one thing which I almost forgot. I think it's just appropriate for us to say to you, and in your presence, to thank Dr. Mokati for the years of service that she has given the bank. As you're aware, she steps down from her position at the end of this month. And we would like to take this opportunity to thank you very warmly for your contribution to the MPC and to the bank as a whole, and wish you well in everything that you do in the future. Thank you all very much indeed.